Health and convenience moved strongly up the nation's shopping lists in the past decade, and food companies introduced a host of new products to meet the demand. In 1980, just 14% of American households had microwave ovens. Now they're in about 80% of all homes, and the food industry has responded with everything from microwave popcorn to French fries to cheeseburgers, all ready to be zapped. In 1983, according to the Food Marketing Institute, only 5% of the shopping public ranked cholesterol levels as an important concern about the food they ate. By 1989, 44% expressed concern about the level of cholesterol in their foods. To answer these worries, there is an abundance of reduced cholesterol foods. Favorites include cakes and pastries like this one from Entenmann's, fat-free ice cream, and low-calorie mayonnaise. Nah. New twists on old products are popular. Ritz followed its popular Ritz crackers with Ritz Bits and Ritz Bits cheese sandwiches. And Hershey's Kisses are now available with almonds. And a happy Valentine's Day to you too, sweetie. Some things didn't last. For example, oat bran demand has plunged in recent years, though it once seemed the fad would last forever. Manufacturers have learned that food actually still has to taste good to sell. With more couples working today, a premium continues to be paid for single-serving, long-lasting products. The food makers have noticed that there's a recession going on and have moved to adapt. An old favorite for cost-conscious consumers is Hamburger Helper, and its sales are better than ever. Tighter budgets have hit Fido, too. Hill's diet prescription pet food, after having a hot few years, is facing more resistance from price-sensitive dog and cat owners. Children's breakfast cereals are very big business for the food companies. Nabisco's Teddy Grahams and Teenage Mutant Ninja Turtles are crunching up sales among the younger set. And as baby boomers age, they're beginning to eat more cereal, too. And one that's starting to catch on with that age group is General Mills' Triples, with rice, corn, and wheat. Maybe it's the right thing to do. What other trends should food shoppers be looking for in the supermarket and the stock market? For some thoughts on that, let's go over now and meet tonight's special guest, Kurt Feurman. Kurt, welcome. We're delighted you could be here tonight.
Nice to be here, Lou.
Have a seat. Kurt Feurman believes that financial food for thought should always include a thought for food. He's a top-ranked food and tobacco analyst for 6 years with Drexel Burnham, for the past 12 months with Morgan Stanley. And like any good yuppie, he usually eats Triples cereal for breakfast. Kurt, by some measures, food stocks have outperformed the overall market in 9 of the past 10 years. Lately, though, they appear to have lost a bit of their snap, crackle, and pop. Is that likely to continue?
I don't think so, Lou. Obviously, if the market were to go up 100 points a week, or continue to do that, these stocks, which are starting from much higher bases than many stocks out there, might underperform, although still rise. But if you look at 2 years, 3 years, even 5 years or 10 years, I think these stocks will continue to dramatically outperform for the reasons they did before. 2 basic reasons. They're financially very strong. They're generating surplus cash flow, and they have underleveraged balance sheets. I'd say today that's a pretty strong commodity to have. And secondly, they're growing their earnings, and over time, that's basically what's going to drive a stock price.
At these prices, which would you buy?
I'm recommending a shopping cart full of stocks, but my favorites right now would be Philip Morris, which obviously is a tobacco company, but is the largest food company in America and the second largest in the world. I also like General Mills, Campbell Soup, and a stock that's been sort of a dog recently, but I think it could move pretty sharply the next 6 to 12 months would be Ralston Purina.
What's behind its prospects now, do you think?
Ralston?
Yes.
Recently, a lot of the winners in the group are not trading at low multiples, so it's nice to find a stock that, that is recession resistant and is generating such great surplus cash flow, trading at a discount to the market. Recently, people have been somewhat concerned over the lack of top-line growth at Ralston, and also the fact that they're generating a little bit less surplus cash flow this year. The stock's really lagged, and They're trading at about 12.5 times calendar 1991 earnings. I think it's a steal. Could easily move from 101 to, say, 115, 120 in the next 6 months.
Back to Philip Morris. How do its food and tobacco components break down in your mind, looking at its prospects?
It's far and away the most attractive stock in my universe. It was the best Dow stock last year, and it rose 24%, and yet its earnings rose 27%, so it really is just keeping up with its earnings growth. They're gaining share in every major market that they're in tobacco. Tobacco, of course, generates even more surplus cash flow than food. In food, they're getting great synergies by having bought Kraft 3 years after having bought General Foods. Going forward, I see Philip Morris growing somewhere between 20 and, believe it or not, 30% annually over the next 10 years. And if you take that out to its conclusion, the stock should be somewhere between 400 and 500 by the end of the decade.
You've said that Philip Morris will have $20 billion in free cash flow over the next 5 years alone. What are they going to do with that kind of money?
It's not a bad problem to have.
I'll take it tomorrow.
Yeah. Well, what they've done is every 3 years make a large acquisition. Last year they made a real tiny one, Suchard, just about $4.5 billion. I think you'll see that they'll start to repurchase their shares again in the next few months. Of course, they pay out 40% of their earnings in dividends. That could go really to 60 or 70% if they wanted to. Probably won't. And I do think they'll keep buying companies. Their debt capacity in the next 5 years, believe it or not, would be $65 to $70 billion. They are generating, I think, more cash than any company in America. And while that's always nice, today, in an environment where banks aren't lending, asset prices are falling, I think being a buyer in a buyer's market is a nice thing to have.
We have
for you.
Very well-fed with brain food group of panelists. Let's turn to them, starting with Carter Randall.
Kurt, RJR Nabisco has reemerged as a publicly owned stock again with a lot of leverage on the balance sheet. How do you look at that at the moment?
Well, RJR is a stock that I was lucky enough to be associated with over the years, and I recommended it when it was public. Got a chance to work on the LBO at Drexel Burnham. It's basically been a great company all the way through, and they've done everything right. They've taken their debt from $29 billion to $17 to $18 billion right now. They're marching towards investment grade, and I think over time it's going to work out just beautifully.
Kurt, many of these companies' growth prospects are enhanced by international diversification. Which companies do you think are the most dynamically positioned because of their geographical diversification?
Quite a few. Philip Morris has just about 40% of its revenues overseas, 28-29% of its profits. Kellogg is a company, it's a great example of, there are some negatives out there for the industry. They've been hurt domestically by the private label business, but they have a tremendous international business, and it's just absolutely booming. CPC is another one, which we're recommending.
Kurt, these companies have done extremely well during difficult market periods. What's going to poise them to do well during the 1990s?
Basically the same thing, Alan. Obviously, as a generality, these companies are recession resistant. I don't think they all are to the same degree. They're not all growing either. I mean, I don't want to make it seem as though every food company is growing rapidly, but if you find the better positioned ones, they have market leadership positions, very high quality of earnings, great balance sheets, great cash flow. They're gaining share in international markets. I don't know what percentage of American industries are doing that today, but not a big number. So it's really the reasons they outperformed in the 80s are the same as the reasons why they're going to outperform in the 90s, I think.
Following up on Alan's question and your answer, which food companies don't you like now?
I'd love to have a few sell recommendations, but I really can't find any. I do have a few that I'm not recommending: Quaker Oats, Sara Lee, Borden, to name a few. And actually, they're all going to go up over time because they are growing. It's just that take a Borden, I would expect 10% profit growth in the first half of the decade annually. That just doesn't excite me when Campbell Soup, because of a dramatic restructuring going on right now, should grow somewhere between 20 and 35% annually.
We have less than a minute left. What do you think of the other tobacco companies?
I think very highly of them. In fact, over the last year, I've actually been more bullish on tobacco than food, because the nice thing about tobacco is for some irrational reason, the stocks traded very low multiples. And you look at Philip Morris, which is growing roughly 25%, trading at a 12 multiple. I like Lowe's Corp, which is the Tisch holding company, very much. And I do like a few more that I can't think of right now.
Well, with all the, you talk about irrational, but with all the talk about smoking being unhealthy, isn't that going to hurt them eventually?
It doesn't seem to hurt them over time. I mean, the problems of the tobacco industry, obviously lower consumption, that's not new.
Thanks very much, Kurt Feurman. Thanks, too, to our panelists. Hope you'll be back with us again next week when we'll get an inside view on what Washington plans to do to your money this year from one of the most powerful men in Congress. He's Senator Lloyd Bentsen, chairman of the Senate Budget Committee and a man whose vice presidential run in 1988 may not have been the end of his national ambitions. So it should be a lively evening. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By the Travelers, over 40 million Americans benefit from our insurance, investment services, and managed health care. The Travelers. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Bates Securities. Rock solid. Market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service.
Because of special programming next Friday.